Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Kevin Carter, founder and CIO of EMQQ and FMQQ ETFs. These ETFs are poised to benefit from explosive growth of internet and e-commerce in emerging and frontier markets. So obviously we are talking about internet and e-commerce in emerging markets today. Kevin, welcome back. Great to have you on the show.
Thank you so much. Glad to be back.
So let's start with China's regulatory crackdown on internet and e-commerce stocks. And we have seen that Chinese technology stocks have bounced back this week. They have bounced back slightly. And that comes after intensive sell-off this year that was brought about mainly by regulatory crackdown in the country. And your ETF EMQQ is down about 18% year to date and about 30% from its peak in February. And I should add that EMQQ is the best performing emerging market ETF since inception. It has handily beaten the broader emerging market ETF as well as the most popular Chinese tech ETF, KWEB, handily beaten that. So we know that companies like Tencent, Alibaba, JD.com, which are top holdings in your ETF as well as in KWEB, they have suffered this year because China has toughened its regulations on sectors ranging from internet to fintech, education, gaming, and they have introduced new rules about collection and use of personal data. And it just seems that regulators are kind of rewriting the business rules for these companies that have just grown too big and too powerful. So talk to us about your thoughts on China's regulatory crackdown on these companies.
Well, I guess the first thing I'd say is I'm not nearly as concerned about it as the market seems to be about it. And, I've been following China quite closely over the last 15 years. And I think the Chinese government's actually quite practical and very efficient. And if you step back and look at this, regulatory issue with internet companies, this isn't really a China problem. It's a problem all over the world. And it's a problem here in the United States. And every week you can see something, some headline about Facebook or Amazon or Google getting fined or sued or otherwise attacked. And because the reality is, as you said, these companies, these platform companies all over the world, here in China, elsewhere, they've grown at an incredible rate. They've got incredibly large. And in pretty much every case, the regulators haven't had a chance to keep up. And now people, again, our government, the Chinese government, are trying to catch up and make sure that rules are in place for all sorts of different things: consumer privacy, data security, antitrust and monopoly abuses. So this isn't really a China story. It's happening all over the world. But the problem is, or at least the difference is, in the case of China, an advantage, I guess, is that they're able to do these things and put in place regulations for the good of their economy and their people, without the lobbyists and the money and the special interest groups and the hearings and the advertisements, from Facebook, et cetera. So this was actually, I think, an advantage of China. But the problem is Americans are so afraid, investors are so afraid of the Chinese government that anytime they get involved with anything, people think, oh my gosh, this is it. They're going to give up on capitalism and steal all my money. And so I understand why people are scared. I don't think they should be. And that's why it's been very easy for me to be pounding the table on the Chinese internet companies over the last couple of months.
You mentioned that you are not too concerned, and it seems that many investors are also not too concerned about these, about the regulatory crackdown and the sell-off and these shares. We have seen a lot of inflows into Chinese tech companies, particularly the most popular one, KWEB, that has gathered more than 6.5 billion in assets this year itself. So, and your ETF has also been an asset gainer this year despite the performance. And it seems that some investors think that this regulatory crackdown is coming to an end probably in the next few months, or they feel that the valuations are very attractive now. These stocks are inexpensive and everyone loves something that is cheap. Getting a deal is always good for everyone, and particularly for investors. And we know that Chinese government and Chinese technology companies, they have been investing a lot, and they want to compete with the West in some critical technologies like 5G wireless, artificial intelligence, quantum computing, blockchain. So tell us about the longer term growth potential for these Chinese tech giants.
Well, I think that in the case of the larger of the companies, of Alibaba and Tencent, of JD, Baidu, they're really not technology companies so much as they are, at least, especially in the case of Alibaba and JD and Tencent. These are consumer companies, and they're digitizing all different forms of consumption in a world that is very quickly becoming dominated by a smartphone-centric world. And they're digitizing healthcare. So Alibaba's got a separate publicly traded healthcare business. JD has spun off its healthcare business. These companies are in entertainment. Tencent's music and entertainment business trades on the New York Stock Exchange. You can think of it as the Spotify of China. It's groceries, the things that are going on in China with food and groceries, and Alibaba's Hema Market. These are just amazing digitization of the food and grocery business, and then fintech. And this is the area that I think is the most powerful part of the story in the developing world, the passing up, the leapfrogging of traditional financial services, starting with bank accounts and going straight to digital money. So it's really, everything these companies are into. Some of them, like Baidu, have maybe some more hard tech types of things and some AI components. Baidu also pretty advanced in self-driving vehicle technology. So these companies are in lots and lots of things, not just selling stuff or talking to your friends online.
Right. Now, let's talk about the investment case for EMQQ and FMQQ. Talk to us about the growth trends in internet and e-commerce in emerging and frontier markets, and how those trends were accelerated by the pandemic.
Well, I mean, both EMQQ and FMQQ share the exact same story. And the story is a story of three different mega trends, three very big, powerful trends that are one directional and long term. And they're things that we are part of, but we've been part of them from the beginning. So we sort of forget that they're a thing at all. But the three things that are captured in EMQQ and FMQQ are, first and foremost, the rise of the emerging market consumer. Billions of people, 85% of the world's people, are in emerging and frontier markets, and they are just now finding themselves with an extra disposable income to spend on more and better food, more and better clothing, appliances, entertainment, vacations, cars, and college for the kids. And that's the first trend. The second trend is called the computer, which is something we've had for, at least I've had for 30 years. But first that was on my desk, and then slowly but surely it got smaller, and now that computer's in my pocket. Well, most of the world has never had a computer, and they're just now getting their first computer. It's not on their desk, and it never will be, and it doesn't have an Apple logo. It's a $60, $70, $80 Android-based smartphone that's bringing the computer to the world for the first time. And it's also bringing the third mega trend with it, which is something I've had for 25 years, called the internet, which I got in 1995 on a telephone line with a modem for the first time. Well, the reality is most of the world was never wired with telephone lines, let alone cable. And so all of these people, as they get that first computer in form of a smartphone, it's also bringing the internet to them for the first time. And those are three very big and powerful trends. And importantly, as I mentioned or alluded to earlier, because the consumption infrastructure in emerging markets is undeveloped, nobody has a bank account with a debit card in their pocket. Nobody has a cable television on the wall with 1,000 channels. And there's no Target store to drive to, even if you had a car. So these people are actually leapfrogging much of what we think of as traditional consumption. And the result is that I think this is not only the fastest growing sector in the world today, but the fastest growing sector in the world ever in terms of public companies and their revenue, which have grown by an average of about 38% over the last decade. By the way, that's per year, 38% per year over the last decade.
Wow. Yeah, definitely. I agree with you. These areas have a lot of room to grow because consumption is shifting online and we are starting from a very small base. And considering population in these countries and the rising middle class and the growing incomes of those middle class people, this is an area with a lot of growth potential. So you talked about trends in emerging and frontier markets, and your ETF EMQQ, as I mentioned, has been the best performing EM ETF since its inception. Tell us why you decided to launch FMQQ and in what way FMQQ is different from EMQQ.
Sure. Well, that's a great question. And so just to be clear what FMQQ is, FMQQ is a new offering, and basically it's EMQQ X China. So if you look at what EMQQ is, it's been dominated by China from the beginning. It's about 65% of the portfolio of EMQQ is China. About 80% of the revenue of the EMQQ index is from China. But it's not just China. There's another 35% in the fund, and that's India and the rest of Southeast Asia, Indonesia, Vietnam. That's South America, Brazil, Mexico, every other country between those two. It's Africa, Nigeria is part of the story. And then it's Eastern Europe, Russia, Turkey, etc. And so the what's happened in China over the last decade has been an incredible growth. And as you mentioned, K-Web has captured that growth. We've captured it. But that growth is spreading now. And China's e-commerce market is so much bigger than the rest of them. So there's 46 countries that are eligible for EMQQ. There's 45 eligible for FMQQ. And the only difference is China. Well, China's e-commerce market is 4 times as big as the other 45 combined. So China's really on its own level. And so by giving investors access to the part beyond China, what they're getting is access to 4 times as many people as is in China, and e-commerce penetration that's only a fifth of what China's is. China's e-commerce penetration is 25%. The rest of what we call the next frontier, the FMQQ countries, the e-commerce penetration rate's 5%. So you got a lot more people, a lot lower penetration. And so it's the earlier innings part of the EMQQ story.
Yeah, it's an area which has a lot of exciting growth potential. And I'm looking at some of the top holdings in your ETF, and there are some which I am familiar with. And could you talk about some of the top holdings that you like a lot and which have a really good story and which have the potential to grow exponentially in the coming years?
Sure. So let me answer that, and also answer a little further your previous question as to what led us to launch this fund now. So when we launched EMQQ, there was only 12 non-Chinese companies. So we had 30 Chinese internet companies and 12 non-Chinese internet companies 7 years ago. Now, about 2.5 years ago, that reached 20 companies outside of China, beyond China. And just in the last 2 years, that number's gone from 20 to 30 to 60. So the number of companies has tripled outside of China, and there's a lot more coming. There could be over 20 India internet IPOs. So this is a story that's going to be in the papers quite a bit. And we've seen these companies raise their venture rounds. over the years, and we've been sort of waiting for this part of the story to reach critical mass, and it has. So that's why it's coming now. And in terms of the companies that have been part of the EMQQ portfolio that we saw really doing quite well fundamentally and quite well in the stock market, I'd say the two most important ones, Mercado Libre, which is MELI on the NASDAQ. That's one of the companies that actually inspired me to make EMQQ in the first place 7 years ago. And that company, it'll show up on the fact sheet as Argentina, but that's a company that's an e-commerce and fintech leader in Brazil, first and foremost, Mexico, the second biggest market, but really operating in all of Central and South America. So Mercado Libre, probably the most important one, and the one that, again, was sort of the foundation of the EMQQ story beyond China at inception. And then another company that people don't really know too much about, trades on the New York Stock Exchange with the ticker symbol SE, and it is called Sea Limited, SEA Limited. And this has been one of, if not the best performing stock in the world over the last 4 years. And it doesn't really have a US equivalent. It's headquartered in Singapore, but it operates 3 different apps all over Southeast Asia, in Indonesia, Malaysia, the Philippines, Vietnam, Cambodia, Thailand, you name it. And they have both a gaming business, they have a e-commerce business, and they also have a fintech and payments business. And again, this has been a blockbuster of a company. So those are the two main ones that I think investors should know about beyond China and FMQQ. But the number of high-profile IPOs that are coming down the pipeline, especially from India, is, I think, really what we're most excited about.
Right. There are many Indian startups which are planning to go public. And I'm really excited about the technology and internet scene in India, because it is a country of more than 1.3 billion people. And the internet industry is in its infancy. So there's a lot of room to grow. And some people think that India could become the next China in terms of e-commerce penetration and internet penetration. And I saw the IPO of Zomato. There was so much excitement around that IPO, and that is India's answer to DoorDash. It is the food delivery giant. And another company which is very exciting is Paytm, which is backed by SoftBank and Berkshire, as well as Ant Group. And this IPO could be valued around $22 billion. So there's a lot of interesting stuff happening in India. And I think those companies will find a place in FMQQ, correct?
Yes, most definitely. And Paytm, as you mentioned, that one is coming pretty fast. That one may begin trading in just a couple of weeks. And as you mentioned, Berkshire Hathaway is one of their investors, invested several years ago in a private round with SoftBank. And I'm an Omaha person first and foremost. So anytime the Berkshire people are involved, it makes me excited. And but the other thing is that as you know, there's a pretty good backdrop for fintech growth in India. You've got a lot of people without bank accounts, and you also have a government that's been very focused and very outspoken on their intentions to digitize all of the financial system, and they've even taken some cash out of circulation. So Paytm's one certainly to be excited about. And then probably not until early next year, but the Flipkart IPO, I think, will also be one that investors will be seeing on the front page of the paper.
Yeah, definitely. Those would be some interesting, very exciting IPOs to watch. Now, switching gears a little bit, I wanted to talk about how these ETFs fit into an investor's portfolio. Are they supposed to replace the emerging market exposure, or are they supposed to be a part of overall tech exposure?
Well, this is a complicated and evolving question for me to answer. First of all, I obviously might be perceived as being biased based on the fact that I have emerging and frontier market products. But so with that disclaimer, and And also with the disclaimer that I've become somewhat radicalized over the last few years in my thinking about asset allocation and modern portfolio theory in particular. And so I guess what I would say is this is any investor that is looking for growth, any investor that has 3 years, 5 years, hopefully, preferably longer, the longer the better in investing. And the miracle of compounding is so important. But if you have a 5 or 10 year time frame, if you're a young investor, you have a retirement account and you're not going to be touching for 10 or 20 years, I think investors should very much consider a meaningful allocation to both of these or either of them. But I really don't think you'll find a sector with more growth in the world. And again, the growth rate's been, in that 35 to 40% range for a long time. And, it'll slow down in some parts of the story, but it's still, I think, going to be the fastest growing sector in the world over the next decade, as it was the last decade.
Excellent stuff. That's all we have time for today. Kevin, thanks for joining us.
Thank you.
Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.